Buy, borrow, and die. Use these secrets of the rich. Now, while the markets are crashing today, many wonder if the Federal Reserve will reverse course on their rate hikes and send the markets higher, or if this is the big bubble burst that many have been waiting for. And while this event seems massive, and even if it is, it's a small blip in the road compared to the long-term credit cycles and your entire investing and lifetime frames. The truly wealthy use strategies and tactics that last beyond a single market cycle, strategies that build legacy wealth to last multiple generations. And as bad as the markets seem today, it's actually one of the very best times to use a strategy like this to copy the rich and to build massive amounts of legacy wealth. So in this video, I'm going to explain what they do, how they do it, how you can do the same, how you can build, grow, and protect more wealth than you've ever imagined if you use and stick to these simple yet not easy strategies. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you have learned is wrong. Now, today I'm going to break down one of the big misconceptions that somebody like Dave Ramsey might be telling you if you're listening to him. Turn him off and let me show you a different way to look at things, something that the rich are doing. I like to say that success leaves clues. You find other people who are very successful. You find out what they did that made them successful. You do about those same things, and you should have about the same results. So, what are the billionaires? What are the ultra wealthy in the US doing? And can you do it? Well, you can. So what they're doing is that the billionaires, the ultra wealthy in the US, they're going further and further into debt at an accelerating rate. Now that sounds crazy at first, especially listening to a Dave Ramsey telling you to get rid of all debt. But they're going more and more into debt. Now, why are the rich doing this and seemingly ignoring what we've all been taught, right? Financial experts and economists commonly tell you that we should pay down your debt as fast as possible, right? Have no debt. Do they know something that, the average people don't know? Well, the wealthy are employing a technique that most economists and financial experts rarely talk about. It's because they don't understand it, they don't do it, all right? Now, they're using the power of leverage to never sell their assets. Now, this is a different type of leverage, but it is leverage, but they're using it to never sell their assets. By not selling your assets and instead borrowing against them, we can unlock the liquidity to spend somewhere else. We can take those dollars out and spend them a second time, a third time, a fourth time, and you won't incur the capital gains tax hit when you would otherwise have to sell the asset. Now, as you can see from the chart that I have up on the screen, Morgan Stanley wealth management clients are doing this at an astonishing rate. As a matter of fact, now have over $68 billion worth of securities-based and other non-mortgage loans outstanding. That's more than double what it was only 5 years earlier. Now, another example of the borrowing boom is seen at the corporate level. We've seen many publicly listed companies are going into debt to engage in buying stock buybacks. Now, buybacks of their own stock were actually illegal back before 1982 until the SEC made them legal again. And they've recently been used on a larger scale after the 2008 great financial crash to drive even more air, even more froth into the asset bubble. Between 2010 and 2019, companies poured a record $5.3 trillion into buying back their own shares. The wealthy all around the world are also accumulating as many trophy assets as they can get their hands on. Now you might be asking yourself, what is a trophy asset? Well, a trophy asset is something that would be considered something very rare, a scarce asset, something that's in high demand. Trophy assets are generally world-renowned items. Think of beachfront real estate in Miami or California. Now, because they're so rare, these trophy properties are extremely valuable and they have a significant monetary premium attached to them because they're in high demand and extremely rare. So properties in these scarce locations in the US can command massive premiums over other nearby properties. Let me give you an example. So I recently purchased a ranch outside of Austin, Texas. I'm going to be doing a video on that, breaking down the numbers and why I did that. If you're interested in how I bought a ranch and how it's making me money and why, what the numbers, the breakdowns and videos, leave me a comment down below and we'll get that going. But not too far from where I bought my ranch is a lake outside of Austin. And there's only so many homes that can go along the lake, obviously, right? Lakefront. And now Austin has become this massive hub. We have Silicon Valley moving to Austin, Texas, and Silicon Valley has a lot of money. Some of those people are making 30, 40, $50 million a year. Now, if I'm making $50 million a year and I want to live on the lakefront, but there's only so many homes for sale. Actually, there's probably no homes for sale, there's one or two. So if I want to buy that home on the lake, whether it's 10 million or 20 million, does it really matter? I make 50 million a year. And the answer is it doesn't. So I have an example. A buddy recently, well, not recently, a year ago bought a house for $10 million on the lake and recently sold it for $25 million. It's a 150% increase. Now, most real estate in the United States has not gone up by that much. Why? Because it's not trophy property, meaning I can go buy other properties in the Austin area. There's plenty to choose from, but there's only one or two for sale on the lake. Does that make sense? All right, now, in order to make more money, right? I mean, that's the journey for most of us. That's the goal, trying to make more money, at least for the 8 billion people in the world. Who doesn't want to make more money? Well, many of us struggle to do that, right? We struggle to make more money and a lot of times never stop to consider the obvious way to do so, which is a penny saved is a penny earned. And so if you can cut your expenses, it's like finding an extra source of income. Now again, back to Dave Ramsey, he's going to tell you never take on debt and stop drinking your coffee. Cut out your coffee in the morning and save that $2 and over a long frame you're going to be rich. I'm not talking about that. But what we can do is we can look at our single biggest expense. For most of us, our single biggest expense is taxes. Now, tax rates in some countries account for nearly 50% of your total income. In the United States, if you're in the top tax rate and you're in a state like California, you're paying over 50% of your taxes or your income into taxes. And so if you can limit your tax bill or even completely get rid of it, it's like basically making double the income. It's like finding a completely new income stream. Jeff Bezos, for example, is one of the world's richest men. And he's managed to escape paying any taxes between 2016 and 2018. Now, I'm not going to get into the details of that or whether it's good or bad, but he's a great example highlighting how wealthy people are able to avoid the single biggest expense, which is paying taxes. And they do that because they simply never sell the assets. And instead, they borrow money against the assets so they don't have to pay the taxes. Now, as I said at the intro, even though the markets seem to be in massive turmoil right now, the macro landscape to deploy a strategy like this has actually never been better. I learned a secret early on in my investing career, and that is there is no such thing as good and bad timing. There's only good and bad strategies. And right now, the timing is perfect for this strategy just like this. All right, so we have asset prices that are all-time highs. Interest rates are literally at 5,000-year lows. And so in this environment, it's never been more attractive to go into debt because the interest repayments on that debt are going to be so low and your assets are so high to borrow against. Interest rates, like I said, historical lows, but we can start to see why debt, and in particular asset prices, are at historically high valuations. If you think about it, the amount of hours required to buy a share of the S&P 500 is 400% higher than it has been in its 150-year average. If we want to take a little bit more of a granular look at this, what's caused this normal asset bubble distortion, we can look at interest rates over the last 40 years in particular. Interest rates over the previous 40 years have been systematically lowered from over 20% in 1980 to near 0%, and even negative in some countries across the world, driving everyone on earth further and further into debt and assets with that debt. Now, we also find ourselves in a very unique position as governments all around the world have also taken advantage of these historically low interest rates to be more indebted than ever before. At this stage, in this long-term debt cycle, with interest rates at zero and debt levels unsustainably high across the globe, central banks have to keep interest rates low. If interest rates were to rise, governments all around the world could default on their enormous debt load. It's a simple economic decision in this macroeconomic environment for those who have access to debt. With governments requiring negative real yields to deleverage their balance sheet, taking on debt to compound your portfolio of hard assets, it's a no-brainer decision from an economic point of view. The calculation is pretty simple. Let me kind of show you, right? If an asset appreciates faster than the interest rate on the loan, you come out ahead. The more you can borrow, the longer you can hold appreciating assets, and the longer you hold, the bigger the growth is and the bigger the tax savings are. Now, we actually have a blueprint to follow for our particularly unique moment of economic history we're living through right now. I've referenced it quite a bit. The 1920s was generally a very inflationary decade for many countries as they enjoyed the exorbitant credit creation and expansion that followed World War I. Germany, in particular, they had a unique case as they went through the hyperinflation of their currency. I've referenced it many times. And as their currency, the German mark, hyperinflated into the 1920s, there's a story that illustrates this, and it's about the richest man during Germany's hyperinflation. Now, most people in Germany at that time lost everything, as the currency lost all of its value in the space of only a handful of years, but not Hugo Stinnes. Hugo Stinnes is known as the quote-unquote inflation king of Germany for how he handled this turbulent economic event. Now, Hugo and his family owned a coal business, which he used as an asset to borrow money against. He borrowed massive amounts of German marks to expand his family's business, and then he diversified into other hard assets like shipping and cargo lines, which he used to transport his coal. And he also bought steel companies, he bought real estate, and he bought gold. By 1924, he had grown his modest amount of wealth into being the richest man in Germany, and his hard asset portfolio ballooned in value, and the debt, he took out massive amounts of debt in the German mark, which was depreciating like crazy. And it depreciated so much that it became worthless in comparison by the time the currency was completely devalued. And so today, currencies all across the globe are being rapidly devalued, right? Making the necessity to buy hard assets like I've been pounding the table on. And it even makes employing a strategy like Hugo did a great idea. So how do you do this exactly? All right, now let's remember, in the introduction, we briefly mentioned the rich only accumulate trophy assets. They don't just go buy any other asset, right? A trophy asset being like lakefront property versus any other asset like a house in the middle of the Midwest in like Missouri, right? If you buy the trophy asset, you can hold it. And if you never sell the trophy asset, then you sidestep all the capital gains that are associated with selling it. Now, there's multiple ways everyday people like you and I can use this strategy. The first thing you can do is borrow against an asset, a hard asset. So you could borrow against your stock portfolio, for example. You can do that just from your stock trading broker. There's many platforms such as Interactive Brokers that you can just click a button, borrow against it. Banks like Wells Fargo and Morgan Stanley also allow you to borrow money against your stock portfolio. Now, this is easier the more money you have, but it's still achievable for almost anyone if you have stocks. Merrill Lynch recently quoted an interest rate of only 3.2% to clients with at least $1 million in assets. Now, 3.2% is pretty much free money when we have CPI at 7%, real interest rates or inflation's at like 15%, 3% is like free money. Now, if you're a little bit more wealthy, if you have over $100 million, you can get a rate of as low as 0.87%, which is why the wealthy can get so much more wealthier, they get it for even cheaper, almost free. But even still, 3.2 is pretty good. Now, another way we can take advantage of this is through leveraging a fixed rate mortgage we may have against our home or even a rental property. So instead of paying cash for a house, instead of paying your house down even faster, paying your mortgage down, like Dave Ramsey might say, what you may choose to do, like many other successful investors are doing, is to refinance their mortgage and draw out equity out of the mortgage. And then you can use that money at the 3% you're borrowing, and you can use it to buy another investment property with that equity or buy another hard asset. You could also borrow money against your Bitcoin at many different companies. I've talked about this before. So you can buy a hard asset, a trophy asset like Bitcoin. You can borrow against that. Companies like LEDN, LEDN are good. They will actually hold it as collateral and they kind of show you proof that they're holding it. So there's not that risk of lending it back out. And Bitcoin's a great example of a trophy asset because it's cryptographically assured to be capped at 21 million coins, kind of like this lakefront property. There's only so many lakefront homes, and there's only 21 million Bitcoin. There's over 50 million millionaires in the world. That means there's not even enough Bitcoin for all the millionaires in the world to even own half of one. So it's pretty dang scarce. And it's even a better trophy asset than beachfront real estate because I can move it with me. I mean, beachfront real estate is scarce, but in Dubai, they basically created a whole new real estate section of town right on the water, right? You can't create any new Bitcoin. There's only ever going to be 21 million coins produced. Now, LEDN allows you to deposit your Bitcoin and then take out a loan against your Bitcoin as collateral. You can also do this other places like the Bank of America, BNY Mellon. They're allowing customers bank-like services for their Bitcoin customers as well. And companies like Ledin also will let you borrow against your Bitcoin and even give you a Bitcoin-backed mortgage loan. So you can start stacking these strategies on top of each other. I mean, this means you could use your Bitcoin holdings as collateral for a home mortgage, completely sidestep the capital gains, and you still get to keep the Bitcoin for the upside potential. Now, until recently, Bitcoiners would have had to sell their Bitcoin to place this, fiat-denominated down payment on a mortgage and incur those capital gains. Now, you can stack this. You could borrow against your Bitcoin for the down payment, and then you can take on cheap long-term debt on the mortgage, which is what I did on the ranch in Austin. Again, if you want to know more about that, leave me a comment down below, and I'll break down the numbers and how I did that. But let me give you a practical example of how this may play out. So if you bought, let's say, $100,000 worth of Bitcoin 24 months ago in 2020 when it was, say, around $10,000, that amount of Bitcoin today is worth about $350,000, which is pretty good. Now, this is where most people make a crucial mistake. Let's say that I wanted that. Let's say I need $200,000 for a down payment. They've made a huge profit. They have $250,000 of profit in their Bitcoin. And so they decide to sell it to get the down payment for the house, right? So they sell it, but the problem is they have to pay capital gains taxes. Let's just, for easy numbers, call it 50%, which means they would have to pay about $175,000 tax for selling the entire $50,000 Bitcoin position. Now, on top of that, you don't have the Bitcoin anymore to continue to appreciate. So a better move would be to borrow against the Bitcoin if you need access to that liquidity. That way you're not paying the taxes. You still have the $350,000 in Bitcoin that can go up. And that's what the rich do. I mean, this is how the rich are able to compound their wealth over time and avoid capital gains tax bills. My mentor for 25 years reading books, and now one of my good friends, Robert Kiyosaki, made himself famous for employing the strategy of using debt to build his wealth over the past 20 years. His book, Rich Dad, Poor Dad, teaches the everyday person on how to use debt as leverage and has become the #1 best-selling personal finance book of all time. In the book, he explains the difference between what he calls good debt and bad debt. And I'll quote him. He said, "Today, many people are living by the old rules of money, the rules of the poor and the middle class. The problem with this strategy is that savers are losers because as the Fed prints record amounts of money, especially as inflation kicks in and grows faster than the interest paid on savings accounts," end quote. So good debt, he would describe as debt that makes you money. Bad debt is debt that costs you money. So good debt would be a rental property that's making you income. Bad debt would be money paying for a vacation on a credit card that you have to pay off over time. He also describes how bad debt can be a financial anchor that weighs us down, which we don't want. We only want to go into debt to accumulate trophy assets that appreciate in value or assets that produce free cash flow. Like I said, debt is a powerful tool if it's used correctly, and it can help you build your wealth up really fast. And as asset prices are at all-time highs and debt is at an all-time low, it's a perfect time for this strategy. But remember, debt still has a lot of risks attached to it, right? It can be very dangerous if it's used incorrectly or at the wrong time. So you got to be careful. I like to say leverage is like fire. It can warm your house or it can burn your house down, right? You got to be careful. But what do you think? Have you used good debt to scale your wealth? Or are you afraid to use it like Dave Ramsey? Let me know in the comments down below. Yes, I've used good debt. No, I'm afraid of debt. Leave me a yes or no in the comments down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't like the video, give me a thumbs down. But that's okay. Give me a comment and at least let me know why. And that's what I got for you today, all right? To your success. I'm out.